All right, today we are diving headfirst into a token that has been setting crypto Twitter on fire, Tradoor. You've probably seen it. On one side, you have people predicting it's the next moonshot, and on the other, you've got serious warnings about huge losses. It's a total mess online, so we're going to try and unpack it all. So here's how we're going to break it down. First, we'll look at the Tradoor enigma itself. Then we'll check out what the project claims to be. After that, it's time for a classic showdown, the bull case versus the bear case. We'll even peek under the hood at the tech and wrap it all up with the big dilemma every investor is facing here. So let's start with this Tradoor enigma. What is it? Well, it's this crazy cocktail of insane hype from its fans, some genuine hope from its community, and, unfortunately, a trail of really significant financial losses. And nothing captures this better than what you see online. On one side, you've got posts screaming, $20 target, Tradoor to the moon, you know the drill. But on the other side, you get these stark warnings that traders are reporting massive losses because the price is just absolutely cratered from its peak. It's a perfect snapshot of the crypto chaos. And that number, a 79% drop from its all-time high, that's not just some statistic. That represents real money, real people, and a real financial impact. It just goes to show you the kind of wild, extreme volatility we're talking about here. So this brings us right to the main event, the big question. What is really going on with Tradoor? Let's try to cut through all the hype and all the FUD, the fear, uncertainty, and doubt, and actually look at the project itself. To really get a handle on Tradoor, we have to start with their side of the story. What is their official pitch? What problem are they trying to solve? Okay, so at its heart, Tradoor is a DEX, a decentralized exchange. Now, unlike a centralized exchange where a company holds your money, a DEX lets you trade directly from your own crypto wallet. The big deal here is you always have full control of your funds. No middleman. So what's Tradoor's unique spin? Well, they're billing themselves as a decentralized Robinhood, specifically for derivatives trading. They built it on the Open Network, or TON, which is known for being super fast, and they're heavily promoting this AI-powered liquidity shield that's supposed to protect users. The whole package is designed to feel simple for the average retail trader. Now, for any DEX to work, it needs money to flow. That's where liquidity pools come in. You can think of them as these big, shared pots of crypto that users deposit their own tokens into. These people are called liquidity providers, and in return for locking up their funds, they earn a slice of the trading fees. It's what makes the whole system go round. And they've made it look pretty simple to jump in. Based on their own guides, you just connect a wallet, find the pool tab, deposit your TON tokens, and you get back these things called TLP tokens. Those tokens basically act as your receipt, representing your share of the pool, and they're what start earning you those rewards. Okay, so that's the official pitch. Now, let's put on our optimist hats and explore the bull case. What exactly has its supporters so fired up about Tradoor's future? A lot of that positive feeling comes from technical analysis. You see posts like this one all the time, from an analyst on Binance Square who says there's a strong setup with 86% confidence. They see the price action and think a big breakout is coming. Then you have the tokenomics. The bulls love to point out that there's a fixed supply of 60 million tokens and that's it. And with a massive 76% of those tokens currently locked up, the argument for scarcity is pretty strong. But, and this is a huge but, you have to look at the distribution. The top 10 wallets hold about 96% of the supply. That kind of concentration is, well, it's definitely something you need to be aware of. And a lot of the excitement is also pinned on their ambitious roadmap. By 2026, they're talking about expanding to other huge blockchains like BNB, Base, and Solana. That could bring in a ton of new users. Plus, they want to become a community-run DAO and roll out a fancy AI trading assistant. It all sounds pretty good on paper. Okay, but for every bull, there's a bear lurking around the corner. So let's flip the coin and look at the red flags and the serious risks that have skeptics so worried, the things that have led to those heavy losses we mentioned earlier. And look, these risks aren't just theoretical. There are claims that over 10,000 traders have already reported taking a significant financial hit on this token. That is a staggering number, and it really grounds this whole conversation in some harsh reality. And just like the bulls have their charts, the bears have theirs too. Here, an analyst named Eliza Ross sees the price action weakening and lays out a whole plan to short the token, basically to bet that the price is going to go down. It's pretty clear the so-called experts are just as divided as everyone else. So if we're going to sum up the bear case, it really comes down to a few key points. First, the volatility is just off the charts. Second, that huge locked supply. While bulls see scarcity, bears see a massive dilution risk. They worry that if all those tokens suddenly hit the market, the price could plummet. And finally, there's a real lack of transparency. No public white paper, no third-party audit, and a very suspicious $2.1 million withdrawal that really freaked people out. All right, let's zoom out from all the market drama for a minute and geek out a little on the technology Tradoor is actually built on. Because to really understand the project, you kind of have to understand the open network, or TON. You see, TON works very differently from a blockchain like Ethereum. Ethereum uses what's called a synchronous model. Think of it like a single-lane road where transactions are processed one after another. It's simple, but it can get congested. TON uses an asynchronous model, which is more like a multi-lane highway. It processes transactions all at once, in parallel. This makes it way faster and more scalable. But it also opens up a whole new can of worms when it comes to security. Yeah, the research on TON points to some specific risks that come with all that speed. You can get these weird race conditions where the timing of transactions can actually change the outcome and cause errors, or delayed state updates, where a contract might be working with old information. These aren't just theories. They are very real challenges that developers have to deal with on this network. So after looking at all of this, the hype, the tech, the risks, we end up right here at the investor's dilemma. It's a classic tug of war between the massive promise of what this project could be and the very real peril it presents right now. So let's just lay it all out side by side. In the bull corner, you've got the ambitious roadmap, the fixed supply, and the super fast tech. But in the bear corner, you have the insane volatility, the transparency issues, and some pretty serious underlying risks. It is a clear fight between potential and reality. And all this really leaves us with one final crucial question. In this high-stakes, high-risk world of crypto, where you have passionate arguments on both sides, how do you, the individual, separate the real signal from all of the deafening noise? That, right there, is the challenge at the heart of pretty much every investment in this space.